Hello, welcome to our University of Baltimore's Meyrick School of Business Regulatory Ethics Update. I'm Mikhail Pevsner. I will be your CP instructor for today. First, let me say that any views that I express today are my own and they don't represent the views of University of Baltimore, University System of Maryland, or any other organizations I was previously or currently am affiliated with. So this is just entirely my own endeavor here, not an official position with anybody. Let me tell you a bit more about me. I'm a professor of accounting here at Meyrick School of Business. I've been here since 2013, started as an associate professor, been promoted to professor several years ago. I also spent 2 years at the Securities and Exchange Commission. They were not continuous 2 years, but rather I spent 1 year as an academic fellow in the Office of the Chief Accountant, and primarily focused on rulemaking and economic analysis of PCAOB auditing standards, and just anything that's audit related. I was part of the subdivision of the OCA called Professional Practice Group, which is whose focus is primarily is in the auditing oversight. And then I went back to UB for a year and did another year after that in the SEC's Division of Economic Risk Analysis as a visiting economist. I was very fortunate in a way because I got to work on kind of a landmark rulemaking of the current chairman Clayton, which is the regulation related to protecting retail investors from sort of abusive practices by broker dealers and financial advisors. I was involved in economic analysis of the rulemaking on the form CRS, Client Relationship Summary, which is a new document that broker dealers and financial advisors have to provide their clients with. It's a new disclosure document that is meant to protect interests of their clients much more and kind of limit the abuse that some of the abuse that we'll be talking about in the course of this lecture today, in the course of this conversation. And so the reason why I was so fortunate one of the reasons why I was so fortunate to be able to do this, these two fellowships, was because of my research interests. I've published 17 original co-authored research papers in the various areas of financial reporting, capital markets, and auditing. I would say auditing is my primary research area, but it's a little bit of misleading statement because I don't just focus on auditing. I have broader research interests, and so I have papers published in top finance journals. I have papers published just in financial accounting disclosure, which is another important area that I work in, and I also am interested in kind of cultural and institutional issues, the role of society at large, and developing financial markets and accounting rules. So some papers in that area as well. To try to be more or less generalist. I have also 14 policy papers which I co-authored. I used to chair and vice chair the Standards Committee of the Auditing Section of American Accounting Association, which is the association of the accounting professors all over the world. And as part of that, I chaired an effort to write various comment letters from academia to policymakers, primarily to PCAOB, but also to the ACC, International Auditing Assurance Standards Board, International Accounting Ethics Standards Board, on various proposals that they had. So that work I've not been doing lately too much, but for a period of quite a number of years, I was heavily involved in that as well. So, very much care about policy, very much am interested in what SEC does, what PCAB does, kind of, rulemaking and policy and so on. So, it's my pleasure again to welcome you all to the podcast. And at this point, I'd like to take our first poll. To make sure that we properly track attendance. All right, so the agenda today is what I was going to go through is primarily SEC developments, which the chunk of the discussion will be spent on recent kind of enforcement actions, and I mean very recent in the last 2-3 months, I would say. There's been a lot of them, even though we've been in the COVID situation, and I'm not even sure if the building is operating as normal. I know most ACC employees are working from home, but they're quite busy. The enforcement division's been quite busy. We'll spend some time on PCAB developments. Hasn't been a lot there. PCAB is going through kind of a transitional period over the last 14-15 months, I would say, because they've had some problems there, so maybe that's the reason why. I don't know, but there was some interesting things coming out of there as well. And finally, I'd like to conclude on a little bit on ESG, environmental social governance issues, which are becoming which are coming out in the limelight much more in the last year in particular. So let's focus on SEC a little bit. Just a reminder, for those of you who may not be as familiar, SEC's mission stands what I call in a three-legged stool. One is the investor protection, then the second leg is the maintaining fair, orderly, and efficient markets, and third, facilitation of capital formation. And the first thing to understand, is that there is some sort of an inherent tension between the three. In other words, it's kind of like a triangle, maybe not a stool. And SEC's policies are some sort of a balance of these three objectives. On one hand, they want to protect investors' interests. They don't want fraud. They want to make sure that people don't lose money. On the other hand, of course, they want to facilitate capital formation. They don't want to regulate so much that that will impede flow of capital. And in the process, they want to do so that they want to accomplish this mission by making sure that they don't impose too much costs on markets, right? So they don't want to make it too difficult for the capital to flow. And that's why we care about orderly, fair, and efficient markets as well. So the second objective is kind of a mix between the first one and the third one. But the first one and the third one are clearly and sometimes could be at conflict. So what's interesting is that, if you look at the behavior of the SEC over the years, and as the chairman of the commission changes, the administrations and the White House change, it's essentially, reflected in the trade-offs between the investor protection and facilitation of capital formation. Depending on which administration is in power, the objective will shift from one to the other, and that's we clearly see in the enforcement patterns. Democrats tend to be much more paternalistic in their attitudes, I would say. So their focus is much more on protecting investors, on more disclosure, on more regulation. And the Republicans are much more, obviously, as we know, laissez-faire, if you will, for lack of a better word. So the focus tends to be much more on facilitation of capital formation. And so the current commission, obviously, is majority Republican commission. Chairman Clayton officially is an independent. So was, by the way, his predecessor, Mary Jo White. But I think it may be fair to say, and that's my only personal view, that, I think obviously Chairman Clayton leans more towards, kind of um, the right side of the equation rather than the left side, for lack of a better word. Mary Jo White was, I thought, was much, kind of really truly to the center. I don't think you could, yes, she cared about enforcement a lot, but I wouldn't be able to say that she was a leftist by any means of imagination, which is interesting because, which probably is the reason why she constantly butted heads, for example, with Elizabeth Warren. There was no love lost there, at least in public. So the Chairman Clayton's focus is so far as, I would say, enforcement policy seems to be on one hand, and regulatory policy, not just enforcement policy. On one hand is to try to reduce onerous and unnecessary, for example, accounting and disclosure regulation, make it easier for companies going public. I think he's made that is one of the key elements of his agenda. But on the other hand, in terms of enforcement policy, he seems to care a lot less, let's say, about accounting violations, at least in terms of how it comes out in the enforcement division, and much more on individual retail investor protection, reducing investor abuse. So, clearly he's not anti-enforcement, but the focus seems to be on much more financial advisors, for example, abuse than, let's say, on corporate disclosure and accounting abuse. So that, to me, at least, reflects somewhat of a political trade-off. He's a centrist, right? So he doesn't want to bend, really reduce enforcement too much. But on the other hand, the focus, the mix of enforcement priorities has clearly changed a little bit to something less controversial and less political, because I think there is a broad agreement, or at least I haven't seen particular debate between Republicans and Democrats on whether we should reduce whether we should not care about individual investor abuse. I think it's pretty much everyone seems to be on the same page there. So I wanted to start with that to just kind of define the, put kind of a framework around what we'll see in the remaining slides in terms of what's coming. Interestingly, I, occasionally get asked by other academics, PhD students about, they have a theory about the way SEC operates. And I had a recent conversation with somebody on that. And this individual asked me, well, I have this theory about, how the SEC does enforcement. And I said, what you're saying might be true, but you need to look at the main goal. And the main goal is that it's a political agency. It's in the sense that it's, appointed by politicians. It's supposed to be bipartisan, but because of its structure that reflects, what it does reflects the administration's priorities. And, within budgetary constraints, they emphasize those priorities. That's the number one thing to understand about this agency's operations. So what have these priorities been in the recent years? In recent months, I should say, I'm sorry. And again, my focus is, I would say, this year, this year 2020, maybe late 2019, is enough to talk about in just last few months. Number one, of course, because of the situation that we're in, and I hope everyone is healthy and safe, is COVID-19. Now, COVID-19 has the pandemic and the shutdown, lockdown, I should say, has several implications for markets. One is, of course, is a huge negative economic shock to markets as a whole. And, that, of course, creates all kinds of issues, right? One is that, for companies, there's going concern reporting, concerns, I should say, about the ability, going concern, continues to go concern, bankruptcy, it probably qualifies as a, there will be a lot more disclosure needed, and we'll see it in the particular second quarter, and so on. So, obviously the Division of Corporation Finance which is charged with with basically accounting disclosure policy, they'll be busy. But the most immediate focus is on the commission has been on preventing investor abuse, because there's a tremendous amount of fake news that's going around, and that fake news, people are obviously very scared of the virus, and they are being taken advantage of by various, I would say, unscrupulous agents, fake companies and so on that make all kinds of unsubstantiated claims to manipulate stocks and so on. So SEC fairly early on, I would say in late February, very much gotten on top of that, and it's been very watchful about all kinds of unsubstantiated COVID-19 claims. So we'll talk about that. The other area that I already mentioned relates to essentially enforcement and investment advisory space, making sure, limiting and preventing and punishing, I would say, investment advisor, broker-dealer abuse. Related to that, of course, are various kinds of Ponzi schemes and microcap frauds, which has, that's an ongoing focus of the commission for several years, stock manipulation, penny stock manipulation, and so on. Another area which has gotten maybe a little less interest in the last 5-6 months because of the obvious COVID-19 situation, but has had a lot of attention, I would say, in the 2-3 years before that, is the area of digital assets. Initial coin offerings, Bitcoin, and so on. Bitcoin itself is not within the commission's purview, that's more CFTC, but in particular, initial coin offerings, been a lot of attempts, I would say, illegal attempts to issue those offerings by bypassing the normal registration process. And the view of the commission, pretty much, it seems to be that any initial coin offerings is a security. That's the presumption. That's not the view, by the way, that's uniform within the commission. For Commissioner Hester Peirce, who is probably the most conservative member of the commission, seems to be, she's gotten this nickname in the Bitcoin community, in the digital asset community, of Crypto Mama, of crypto community. She seems to be more libertarian in her views, but I think the rest of the commission, pretty much is very skeptical about that, and so they want ICOs to be registered, and so there was over 700 cases, I believe, of alleged ICO frauds, and the commission has vigorously prosecuted them. And we'll talk about some of the more recent ones. And of course, traditional accounting fraud enforcement hasn't gone anywhere. It just, I guess, it's not getting as much publicity lately in terms of percentage terms. That was a very serious focus of Mary Jo White, who is Chairman Clayton's predecessor. She was the Obama appointee, and so, in her time, for example, it was entirely the opposite. There was tremendous focus on accounting and accounting fraud and proprieties enforcement, much less so today. I think the focus of the enforcement division today, in terms of accounting, is to go after the big potatoes, right? Very serious violations. And on the Mary Jo White, there were much more no broken windows policy, which is even small violations were prosecuted. They just kind of get people online. So it just shows, again, I emphasize kind of the shifting priorities depending on who's in power. All right. I also want to talk a little bit about, when it comes to SEC getting us outside, a little bit out of the realm of enforcement, talk a little bit about the regulatory activities. Commission obviously is in constant rulemaking mode, and there's a lot of rules that are coming out. So some of the ones that I think are more relevant to this audience, to myself, I'll talk about them. Obviously, there are some that this is not an exhaustive list by any means of imagination. There will be more there are more rules that they're just more technical in nature, so or less relevant to accountants. So that's why I am not focused on them. All right, so here's the just a breakdown of the enforcement activity, and this is from one of the websites that tracks SEC enforcement. There are several. In terms of the number of enforcement activities in 2019, we had a more active year than, let's say, 2018. Certainly more active than 2017. Uh, Obviously they're busy. They're not less busy than before. Just to give you a sense, Chairman Clayton became chairman in roughly a little over 3 years ago, April of 2017. So this is his kind of realm, his reign, and this is Mary Jo White. So and so to this year is very much comparable to 2016 when Mary Jo White was essentially the last year for tenure. So it's not that commission does less. If in terms of the penalties collected, I would say, obviously it's in 2019, it was more active, I would say, more penalizing than before. It's just the mix that has changed. All right, so so this slide gives us kind of a breakdown of what type of and so you could see 2019 offering market manipulation cases, 26% was the largest, one of the largest percentages. Accounting auditing only 17%, right? So again, it's still significant, but reflects, I think, the change in focus. Broker-dealer cases, 7%, not a huge number, but a significant one. And the others, insider trading, comparable, but no huge, right? So market manipulations offerings, right? If it was the biggest one, and accounting is the second one in place. So in February 2020, SEC's Office of Investor Education and Advocacy issued an investor alert on COVID-19, right? We were still early on, but they were in the process there, as you recall. But already in early February, they were concerned about knowing, I guess, from past experience, that people will take advantage of the situation, of the uncertainty. They issued an investor alert to investors, making sure that they're not exposed to scams. So here say we become aware of a number of internet promotions, including social media, claiming that the products or services of publicly traded companies can prevent, detect, or cure coronavirus, and the stock of these companies will dramatically increase in value as a result. The promotions often take the form of so-called research reports and make predictions of specific target price. Obviously, those are clearly fraudulent, but it just shows that we were still in the fairly early stages this year in America. By February 1st, I think had one known case in Washington State, but people were already trying to take advantage of the situation. Just to give you a sense, by the way, Office of the Investor Education Advocacy is a great office. I've dealt with them as part of my job there. They really tried to educate investors on their rights, on making sure they don't lose money and so on. So it's one of those supporting offices that people don't tend to think about, but very important one, by all means. So Stephen Pakins in May 2020, Stephen Pakin is one of the core directors of the Division of Enforcement, gave a speech on enforcement priorities. I basically just here I'm posting except from that speech. And so one area of focus, obviously, is trading suspensions for stocks which make all kind of unwarranted claims. So here he says, since February 7, the Commission has suspended trading in securities for more than 30 issuers as a result of questions about adequacy and accuracy of coronavirus-related information. The suspensions followed a broad range of claims by issuers, including those relating to access to testing materials, development and treatment of vaccines, and access to personal protective equipment. The Commission has also suspended trading in the stock of at least 3 microcap issuers whose names and ticker symbols closely resemble those of unrelated companies whose products are actually relevant to COVID-19, such as testing, N95 mask, and video conferencing technology, due to concerns about investor confusion, among other things. So, for example, with respect to video conference, they suspended the Chinese stock, which had a name Zoom in it, right? Obviously, that was a penny stock. Had nothing to do with real Zoom, but people were very much confusing it with the real Zoom. Now, by the way, this issue of investor confusion over names is non-trivial. I mean, there's actually research that shows that when 2 stocks share a similar name, they tend to very much kind of follow similar patterns. And they're aware of that, and I'm glad they did that because people, in that case, the name was, you wouldn't know that's not real Zoom. And a completely unrelated stock, and we don't want to lose money on that. So the other area that obviously is gaining some traction or gaining some attention is paycheck protection loans. And so this is from another website that follows the SEC. SEC enforcement appeared to initiate a sweep of public companies that borrowed money under the PPP, Paycheck Protection Program. Specifically, SEC enforcement is sending voluntary inquiries requesting information regarding companies' eligibility to receive PPP loans, including COVID-19 impact on business. Eligibility for a PPP loan is based in part on certifying in good faith that A, current economic uncertainty makes the loan request necessary to support the ongoing operations. So, the human nature is such whenever there is an opportunity to take advantage of the situation that obviously people do. And so, I'm sure that I think this is reflective of the fact that there are actors out there that want to take advantage of an opportunity to get some cheap money from the government. Obviously, it turns into the loan is forgiven if you keep paying your payroll after a period of time. So, the Commission is obviously concerned that people don't unfairly take advantage of the situation. Here, in addition to that, what's interesting related to PPP program, there was already a shareholder lawsuit against Wells Fargo. This is not an enforcement action; it's a corporate private security litigation action. And so the plaintiff alleges that the defendants, meaning the Wells Fargo Bank, made the misleading statements and failed to disclose that A, Wells Fargo planned to and didn't properly allocate government-backed loans under PPP, and that inadequate controls in place to prevent such misallocation. And foregoing foreseeably increased the company's litigation risk with respect to PPP allocation, as well as its increase in regulatory scrutiny and potential enforcement actions, and as a result, the company's public statements were materially false and misleading at all relevant times. So what's interesting about this lawsuit is that it underscores even the risk of banks involved in this rather, abruptly rolled out program, and we'll see how it all plays out, right? I mean, there's obviously just an issue of basic fraud with respect to eligibility, but also even the banks that are involved in dispersing the money themselves are potentially at risk if they don't have the time to do the correct level of due diligence. So Pakin also, again, outlined in this speech the enforcement priorities, which, I mentioned the microcap fraud as one, related to pandemic, insider trading, corporate disclosure, accounting fraud, in particularly highly impacted industries, right? So the concern is that, and this is something that's very basic, we're all aware of, that, when anytime there's a very serious distress, the chance for accounting fraud goes up. And so, because, there's a pressure to survive, so people are more willing to finagle with the numbers. So, and the areas will be improper disclosures or insufficient disclosures. Impairment will be a very major concern, and here will be impairments of inventory, impairments of goodwill, just general valuations. It's very similar to what we were experiencing in the financial crisis of 2007, 2009, where obviously, there was a lot of concern about valuations of securities. And here, I don't know to which degree the securities industry will be impacted. But certainly similar, right? Anytime you have an impairment shows up, anytime you have a downturn. Now, with respect to the securities industry, I just read an article which was kind of interesting, related to leverage loans. So, we've seen leverage loans are essentially very high risk loans, corporate loans, right? Similar in some ways to subprime consumer debt or mortgage debt we saw during the crisis. Now, this is corporate market. What's interesting is that the leverage loans are being financed through CLOs. Like, remember, you're all probably remember the kind of almost a pejorative term CDO, called collateralized debt obligation, which were this investment vehicles which were basically based on tranches of mortgages. But CLOs are collateralized loan obligations, which essentially, again, are investment products, derivatives, deriving its value from value of those highly leveraged, high-risk loans. And a year ago, this was already a concern. In fact, Finance Committee of the United States House of Representatives held a hearing on the impact of those loans, and in particular, the Democratic members of the committee were very, very concerned, right? Is there a lot of risk here? The majority, I watched the hearing, the majority of the committee, so the witnesses, were not that worried about them because percentage-wise, at the time at least, this was a year ago, leverage loans were in single digits percentages in terms of the overall loan market. Now, but this was at the time where we didn't have this sort of essentially what's called a black swan event, which is the COVID-19 pandemic is. And so, at least one article I read recently suggests that there may be a risk of a contagion with this leverage loans, in particular for banks who are exposed to them, and large banks, if there is a massive default in the leverage loan markets. Now, think about it this way. What's going on essentially is that we have a sudden negative demand shock across the economy. A lot of companies which have taken out those high-risk loans may end up being in default. Again, all of those loan obligations work great so long as the risk is reasonably diversified. Again, there is no systemic shock. And here we have a perfect systemic shock. And right now, I think nobody knows really how concentrated those loans are across which banks, and which banks are holding them as assets. If if they're not sufficiently spread out across different banks, we may have another, as the defaults spread out over time, we may quite likely get possibly a banking crisis of sorts. Now, how big is it going to be? It's hard to judge. I mean, hopefully the numbers in 2019 that I've heard, they were not that huge. But we may have to deal with another bailout of the banking industry, which is scary, which is very scary, because the one that we had back in the 07, 08 was a big deal. Now we're in much worse shape economically. So this is something that I guess we need to watch out for. I mean, as this pandemic and crisis continues, you know, we need to be very mindful of that. Now, the other thing, also interestingly, we've had the Dodd-Frank Act now for almost a decade, and it will be a test really whether the protections that were put in by Dodd-Frank Act to prevent another banking bailout, if there needs to be one, um, would be deemed effective. And I already mentioned to you the investment advisor and investment company misconduct, which is very much the focus of Main Street investor or retail investor protection. All right, so I think now is a good time to do another poll, and then we'll proceed to the actual enforcement cases. So here we have an example of one such COVID-19 enforcement action, which is mentioned in Stephen Pakin's speech. Praxin Corporation stock was suspended on March 25th. Suspension was due to questions regarding the accuracy and adequacy of claims Praxin made in pair of press releases about having been able to obtain large quantities of N95 masks used to protect wearers from COVID-19. And this is the theme that will flow through multiple COVID-19 enforcement suspension actions, enforcement actions about false and misleading claims. So here's another one. Penny stock trader in Santa Cruz was charged with conducting fraudulent pump and dump scheme in the stock of biotechnology company by making hundreds of misleading statements on online investment forum, including false assertion the company has developed an approved COVID-19 blood test. So this is a stock manipulation scheme. Microcap fraud scheme, participants attempting to capitalize on COVID-19 pandemic, an emergency action by the SEC and an asset freeze against 5 individuals, 6 offshore entities, an alleged fraudulent scheme that generated more than $25 million from illegal sales of multiple microcap companies' stocks, for which were subject to the recent SEC trading suspension orders. So here's the Nanomagic one. The Nanomagic one is interesting because here the SEC suspended the stock, but then Nanomagic phoned back. And this is the Wall Street Journal article. Nanomagic, a maker of lens care, anti-fog electronic device protection products, mounted a novel challenge to the SEC decision on April 30th to temporarily freeze its stock of online claims that the disinfectant company has held the patent could kill the novel coronavirus. So what's interesting here is that the company itself wasn't making any claims. It's other people on the Twitter platform were making those claims without company's authorization. So Nanomagic says it wasn't associated with the authors of the posts. It wasn't responsible for allegedly misleading claims. It claims it wasn't even aware of the online activity until it was contacted by the SEC a week before the suspension order. So what's interesting is that obviously it's against securities laws to intentionally make false and misleading statements. But here, it's a situation where somebody else is attributing things to the company which they have no control over. And it's kind of a new frontier, at least to me, that, we live in this world where anybody could say anything they want on social media. Underscores the need by companies to control what really goes on around their brand name on social media, because theoretically this could happen to anybody, and so we need to be kind of very worried about it with respect to our online imprint. All right, so the second category of enforcement actions was related to the advisor misconduct. And in particular, you have to the concern here is that investment advisors, broker-dealers act take advantage of their clients, in particular investment advisors. Investment advisors are, of course, required to act as fiduciaries for their clients, that is, have their best interest in mind. And a lot of abuse historically had been with the offering clients high-cost products, where the advisor essentially gets a kickback from a fund for doing so, right? That's a little bit more murky with respect to broker-dealers, because broker-dealers, at least until Reg BI came about last year, were required to satisfy what's called suitability standard, which is much lower than the fiduciary standards. Advisors are very subject to the fiduciary standards under the Advisors Act. So Section 206(2) of the Advisors Act prohibits an investment advisor directly or indirectly from engaging in any transaction, practice, or course of business which operates as a fraud or deceit upon the client or prospective client, and imposes a fiduciary duty on investment advisors to act in the client's benefit, including an affirmative duty of utmost good faith and full disclosure of all material facts, right? So the whole issue is that if you are offering a client a highly expensive product and there's a lot of fees, and you're getting a kickback for it, essentially a high-level commission, you're at the minimum required to disclose it, but it's probably acting out, even if you disclose it, possibly is not in line with your fiduciary responsibilities. So, and you see a slew of those actions. And we were talking about how the current chairman's priority is protection of retail investors. And so you see a slew of enforcement actions in the advisory space. So here's one, litigation release from June 4th, 2020. The Securities and Exchange Commission has obtained a final judgment on more than $30 million in monetary relief and actions against Neville Associates. The Commission charged the defendants in federal district court, alleging that they breached their fiduciary duties and defrauded the advisory clients through use of marketing materials that included false, misleading statements regarding past performance of the firm's investment strategies. So it's not just about fees, but also just kind of lying to you how successful you are in this particular case. I started talking about conflicts. Here's the conflict case in the matter of Augsburg Advisors. May 2020, Augsburg is a commission registered investment advisor. Firm failed to properly disclose 12b1 fees paid in connection with client purchases of certain shares. So this is an example of failure, essentially overcharging clients and failure to disclose conflicts of interest. I mentioned to you that when I was at the commission, I worked on Form CRS, which is a disclosure document that summary disclosure document that every advisor and broker-dealer will be expected to give their clients starting actually June 30th, and about 2 weeks from now. And specifically, that form has a required disclosure of conflicts. Another one, March 11, 2019, it's a little bit earlier than a year ago, Securities and Exchange Commission announced settled charges against 79 investment advisors who will return more than $125 million to clients, with a substantial majority of the funds going to retail investors. All right, this is part of the so-called Share Class Selection Disclosure Initiative, which SEC's Division of Enforcement announced February 2018, in an effort to identify, promptly correct ongoing harm in the sale of mutual fund shares by investment advisors. So this is this 12b1 fees issue. Overcharging fees is a major concern, and failure to disclose conflicts is a major concern to the Commission. SEC orders have found, and specifically it says, that investment advisors had failed to adequately disclose conflicts of interest related to the sale of higher cost mutual fund shares, classes when a lower cost class of shares were available. So that's Form CRS requires disclosure of conflicts. Now, one of the issues that comes up in connection with the Form CRS and Form ADV, which is a much broader, much more technical form that a lot fewer people can understand and even read, that it's great to disclose conflicts. Now, what will happen if you actually disclose the conflict? How will a regular mom and pop investor understand this disclosure of conflicts? first of all, I'm an economist, and even for me, for who's trained in these things, if somebody says, "Oh, I have a potential conflict of interest with this or that," I mean, it requires some mental effort to really understand what does that mean. Okay, um, but one of the interesting things that research in psychology shows that the presence of this conflict disclosure, the intent is to alert you and maybe say, wait a minute, maybe you don't want to go with this person. Actually, could have the entirely opposite effect. People might perceive it as, oh, this person is honest. They're telling me about disclosure of conflicts. I have to trust them more. I can trust them more. So it remains to be seen. It's very over time whether this more prominent disclosure of conflicts will actually achieve its intended effect. So looking forward to that. It will take a few years before we can say anything there. Before we can see anything there. So this is the Augsburg slide, but 12 fees. Here's another one. SEC v. Tamar Steel and Steel Financial. May 20th, 2020. There's a final judgment. Now this went actually to court. A SEC complaint from 2018 alleged that between December 2012 and 16, Steel Financial sold advisory clients and their investors more than 15 million of securities of behavioral recognition systems, a private company, which SEC previously charged with fraud. This company targeted the advisory clients, selling approximately 13 million of their securities to more than 120 clients without disclosing that they were receiving commissions from bearers. Here's an interesting issue. Obviously they're selling, it's a private placement here. They're selling, to be able to sell unregistered securities, you have to be what's called an accredited investor. That's number one. Number two, obviously this company was charged with fraud. Number three, there's a failure to disclose conflicts. And so another area of concern with advisories, specifically financial advisory, is sale of this high risk private placements, which we hear a lot about in the media about so-called very large valuations of companies, unicorn firms, right? Uber used to be one, and Airbnb, and all of those others. They have these crazy valuations. At least pre-current crisis had them, and at least there is some degree of media transparency. And I think about some small unknown entities, the whole issue with private placement there, and potential sale of those securities, because there is no disclosure. They don't have to provide any financial statements or anything like that. They're obviously not even audited. That's number one. Now, here we talked about the tension between excess, capital formation objective of the SEC and protection of investors objective of the SEC. The current chairman made it his priority to increase investor access. So to companies that would go public earlier, so that they have more opportunity for the upside. I think the big issue was that the argument goes like this: when Microsoft went public in the 80s, it went public in a much earlier stage. Today, companies go public in much later stage, typically. And so, if you bought into Microsoft when it initially went public with much lower capitalization at the time, your potential for the upside, and you held on to the stock, presumably, you could be very, very wealthy today. Of course, you were facing a tremendous amount of risk as a result, right? So in risk-adjusted terms, that's not necessarily a fair statement. So the idea is we want to encourage companies to go public earlier, when they're cheaper, when they're smaller, so that mom and pop retail investors, Main Street investors could buy into those stocks. If only companies that go really large, go public when they're really large, A, they're much more expensive. B, by that time, you already have had multiple rounds of financing from private, institutional investors, and so on, and angel investors and VC funds and so on. So what do you have left on the table for you, right? Your upside is much more limited. Of course, your risk is also much more limited at the time as well. So obviously, here's an example of a private entity which committed fraud, which was marketed to, you know, fraudulently marketed, I would say, to unsuspecting mom and pop investors. In this case, advisory clients, whatever that means, that they have to have satisfied the accredited investor exception, right? So maybe they were wealthy doctors and lawyers or whatever, maybe small business people that satisfy the net worth requirements. Incidentally, by the way, Commission is currently working on, or it has a proposal, I should say, to essentially relax accredited investor qualifications. So. So on one hand, we want to have more people access to to companies about to go public earlier or they go public earlier. At the same time, we can see there is a huge potential here with risk, potentially with fraud. So how do we trade those two things off? That's an open question, right? That's what people are debating on the Democratic side of the commission. That's why there's a huge opposition towards relaxing accredited investor qualifications. There's, I don't know if there's as much opposition to increasing access to, increasing number of public companies in the U.S., which have gone down quite substantially. We're about, today, depending on how you count, 8,000 public companies on the U.S. markets compared to close to 13,000, I would say, at 20 years ago, right? At the height of the dot-com boom, when that was the boom of public markets in the U.S. as well. So my point is that this is an example how you need to try to weigh those things together and trade them off. Obviously, the Commission also looks at Ponzi schemes, continues to look at Ponzi schemes. We are at now close over 12 years since Madoff, disclosure of Madoff Ponzi scheme, which is the largest, as we know, Ponzi scheme probably in recent history. But you don't have to be Madoff. I mean, people still continue to do that. So, for instance, Cecilia Smith actually names defendant Smith and his entities, North Star Communications, and so on. Since January 2018, defendants have been hosting investor events at which they marketed securities claimed to pay guaranteed return ranging from 3% to 10%. In fact, there were no investments. Defendants misappropriated the funds and channeled portion of the investor funds back to others, Ponzi styles. They raised about $6 million from 35 investors. So, the moral world changes, the moral world stays the same. Now, if somebody markets a return to of 10%, that doesn't sound like, crazy, right? If it's, that's not crazy, actually. I teach financial statement analysis class, and, 3% certainly not crazy, right? 3% is, very normal. So the issue is, you don't need to. What I find fascinating about this one is that, we tend to think about, Madoff was this crazy thing, right? So he essentially touted consistent positive returns without risk. And that's how Harry Markopolos was able to expose him. Nobody would listen, as Harry would say. SEC has failed miserably at that because he came to them years before Madoff actually came forward and admitted that he was a fraud. But Madoff was making much more egregious claims. Fundamentally, the people bought into it. Here, I find it fascinating that Ponzi schemers, I guess, are learning their lesson and then think, okay, to be credible and to be able to steal, you cannot make very egregious claims. Now, what's interesting that people buy into that. That's an example of, I think, the fact that there's very low opportunity to reach for yield in the current market. if you have cash parked somewhere, obviously it's earning close to nothing in the savings account. Treasury, securities also yields are very low. So, if you want to make more money, you're going to start taking risks with your money. And here's an example why you do that. And if you want to steal some money from people, so it shows that they don't need to be promising, 20% returns, 15% returns, 10% consistent returns. You're going to promise 4%, 5%. People will go for that because there's it's much harder to get it anywhere else. And this underscores the need to educate people that there's a lot, even when it sounds credible, when it sounds reasonable, um, you're taking a big gamble by going with some sort of a private company, which is unaudited and so on, or with some sort of investment pool, like in this case. Here's another one. On June 30th, 2020, a United States District Court again entered a preliminary injunction and orders freezing assets for imposing other asset relief. An SEC complaint filed on May 19 alleges that from at least January 18 through May 2020, so very recently, Smith offered and sold securities in his company, North Star, right, to market the securities. So this is essentially a complaint, official complaint to what we just looked at. So now over the period 2.5 years, defendants solicited investors to purchase limited partnership interests in oil and gas projects. They were told to be used to drill new wells and they work existing ones. They were promised a return of 32%. Well, this one again, I mean, that's crazy. That's crazy. Nothing returns of that level or cannot be promised reasonably. So, this is a very traditional Ponzi scheme where people just believe stuff that is too good to be true. Here's another one. Another asset freeze. Putnam operated a multi-level marketing business known as Modi Mining Team and sold interest in purported cryptocurrency mining operation nearly 200 investors. According to complaint, Putnam misappropriated some of the investor funds and spent them on condominium and other personal expenses. Okay, so I mentioned that the commission has been very focused on crypto enforcement. And this is an example where people, I guess, again, kind of behaviorally hear about crypto that being so great and buy into that. And, unscrupulous actors take advantage of that. So that brings us to the discussion of digital assets. And in the 18, there's a statement on digital assets and issuance trading from CorpFin Investment Management and Trading and Markets, talking about, essentially their enforcement program, almost like against unregistered ICOs. We wish to emphasize that market participants must adhere to a well-established and well-functioning federal securities framework when dealing with technological innovations, regardless of whether securities are issued in a certificate form or using new technologies such as blockchain. So the whole issue is, as I said earlier, whether the ICOs qualify as securities. And I'm yet to see one serious case, and there's been about several hundred were attempted, where a commission would agree that a digital token is not a security. So essentially, there are attempts being made there in that space, but most of them were shut down by the commission, including, by the way, not just the unregistered token offerings, but also the cases of commission stepping in and dismantling unregistered token exchange, and so on. So there's an ongoing litigation, interestingly enough, between Telegram, which is a very famous app, communications app, and the SEC. They're litigating in court over Telegram's offering. Telegram legitimately, hired lawyers and attempted to, design a security, design a token or whatever, an offering that wouldn't need to be registered. The SEC disagreed. So that's one interesting one where it remains to be seen where it's going to go. But mostly, SEC so far has prevailed in essentially shutting down all of those crypto offerings. So, just as a reminder, how do you decide that something is a security or not? And this is from one of the SEC documents. You have to apply essentially the so-called HO standards. Security, remember, includes an investment contract. Investment contract is an investment of money in a common enterprise with a reasonable expectation of profits to be derived from entrepreneurial managerial efforts of others. The definition embodies flexible rather than a static principle, one that's capable of adaptation to meet the countless and variable schemes devised by those who seek the use of money of others and promise profits. The key case, of course, is Howey, which is Howey test. The test permits the fulfillment of the statutory purpose of compelling full and fair disclosure relative to the issues of many types of instruments that in our commercial world fall within ordinary concept of security. So essentially, most tokens, or pretty much all of them, fall under the definition, and despite the best attempts of doing, bypassing that, and so far the Commission steadfastly held to that. Here's another example. So it's an early stage blockchain services company. Beginning June 2017, continued through November of that year, the firm sold digital tokens called consumer activity tokens to about 9,500 investors, including individuals in the United States. The purpose was to fund development of its blockchain-based search platform. The interests were sold as securities that were not registered. Specifically, they were investment contracts. So again, a digital token typically is kind of like gives you certain rights, and it derives its value, I guess, from for instance here, whether this blockchain will be successful or not. So the Commission applies Howey in this case. If you go back to the case, the definition. It's an investment of money, which in this case it is an investment of money because it's listed in funds, in a common enterprise with a reasonable expectation of profits to be derived. So if the blockchain is successful, they'll get profits out of it. They'll get rights out of it. So that's how they interpret the law here. I guess one argument why this shouldn't be security would stem from the idea that this is not like they'll get dividends or anything like that. They'll get maybe special rights to the system or something like that. The Commission is not buying it once it is successful. Here's another unregistered 25.5 million ICO issuer to return money distribution to investors. So again, another blockchain services company, and unregistered ICO. They raised 25 million by selling its consumer activity tokens to approximately 9,500 investors. So that's the same one we just looked at. The order finds that, as explained in the offering materials, BitClave planned to use the ICO proceeds to develop, administer, and market a blockchain search platform for targeted consumer advertising. Here's the punchline. The BitClave emphasizes expectations that the tokens would increase in value and took steps to make the tokens available for trading in third-party digital asset trading platforms after the ICO. So that's, I think, the damning statement, really, right? So essentially, it sounds, smells, and tastes like a security, no matter what your claims are like. So in another matter, John Donovan, here now we are actually moving on away from the Bitcoin, and so on, to the ICOs, to now something more prosaic, much more relevant to all of us. Actions against accountants and auditors. The now infamous case of so-called steal the exam scandal, which I'm sure many of you have heard of, where there's two parts of it. One part in KPMG, National Office Audit Partners had facilitated a scheme to procure advanced knowledge of which audits will be inspected by PCAOB. That's part one. Part two, also in the course of some sort of other investigation, it turned out that some of the KPMG staff members cheated on a test they had to take as part of mandated continuing education requirements, as part of penance that they're paying for something else they did earlier. So this is the part two part, where in 2018 the former engagement partner shared answers to 3 or received answers to 7 questions on training exams administered by the firm with junior members of the engagement team. PCAOB ACPA rules require that members act with integrity, and that's of course a violation of integrity to cheat on an exam. That's now that's been a huge embarrassment to KPMG, I would say. KPMG settled for a very substantial amount of money with the commission for these violations. In general, so that's what the commission says about this specific case, or part. Commission brought a settled action against KPMG arising from violations of PCAOB Rule 3500T, which requires firms to maintain integrity and performance of professional services. Commissioner order found that KPMG admitted to significant misconduct. Misconduct included scheme involving theft of confidential information, and they had to settle for $50 million, as this shows, which is a very serious amount of money, but also a huge hit to the reputation of the firm. KPMG wasn't the only one. There was in terms of actions against accountants, there was an action against PwC for independence violations in connection with this guy Brendan Sprinkle, who was a partner who violated independence rules with respect to procurement of non-audit services. SEC order finds that PwC violated SEC's auditor independence rules by performing prohibited non-audit services during the audit engagement, including exercising decision-making authority in design and implementation of software relating to an audit client's financial reporting and engaging in management functions. In connection with performing non-audit services of 15 SEC-registered audit clients, auditor states that PwC violated PCAOB Rule 3525, which requires an auditor to describe in writing to the audit committee the scope of work discussed with the committee, potential effects of the work on independence, and document the substance of independence discussion. So just as a reminder, Sarbanes-Oxley Act broadly prohibits provision of non-audit services to audit clients, subject to some exceptions. Now, those exceptions have to be approved, of course, by the audit committee, have to be clearly described. In this case, obviously, this wasn't the case. There was some sort of software implementation. Software implementation is something that we routinely tell students you can't do, right? Unless it somehow is related to the audit and the audit committee approves it, and it's kind of a very touchy subject, I would say. It's very different, let's say, doing a tax return, which is understood, most of the time is approved. That's would be much more questionable. And obviously, the SEC came after that for the actions of this one partner. Switching away from accountants, insider trading continues to be an area of concern. They have a very robust insider trading monitoring program with all the trappings of very sophisticated forensic techniques, and so on. And here's an example of insider trading by an accountant. We've seen, unfortunately, a trickle of those cases, but consistent trickle over the last few years, were obviously starting with Scott London case, who was a KPMG audit partner several years ago, who went to jail for it. But it's been several more. Here's a recent one. This lady was an accounting manager. So the accounting manager told contract accountant Jana Faith Kiana and others company would have disappointing revenues. And so so this person insider traded on this information. She was a CPA, obviously, and it's kind of pretty bad. Another interesting case, which is, I would say, a new frontier for the SEC in the disclosure realm. Now, typically, enforcement cases are rarely about disclosure, failure to disclose stuff. In the sense that, like stuff in the MD&A is much more soft, harder to prosecute. Here was an example of, and I've never seen a case like that before. A company is being prosecuted for or being sanctioned for failure to disclose 1.2 million in perquisites and personal benefits to the executives. So, I'm sorry, it disclosed that it is 1.2 million, but according to the order, failed to disclose over 5.3 million and paid to the CEOs on CEO's behalf, including filings that after shareholder issued press release alleging undisclosed perks to the CEO. The order finds that the perks Argo paid for but did not disclose include personal use of corporate aircraft, helicopter trips, and other personal travel, housing costs, transportation of family members, personal services, club memberships, tickets, and transportation and entertainment events. So you got to disclose perks to the as part of the executive compensation, and this is a rare case. I don't think I recall seeing one where SEC actually sanctions a company for failure to do so. Now, a little bit about the commission's whistleblower program. Commissions in this month awarded its largest award ever, $50 million to a whistleblower. And whistleblowers, of course, awards have become much more prominent in the Commission's work ever since the adoption of the Dodd-Frank Act, which provided much stronger protection to whistleblowers. Commission uses something called TCR system, which is tips, complaints, and report system to catch, bad actors. And this was implemented in connection very much with the Madoff scandal. And it's been incredibly useful, I would say, in pursuing enforcement activities. And, you can see now that people are much more willing to come out and be whistleblowers because, A, you're getting more money for it, B, the protections that you have as whistleblowers are much stronger than before. So, here are some reasons why the whistleblower program has been more successful. Strong financial incentives, anonymous reporting. Most individuals are eligible to receive awards. So, much broader list of people who are eligible to be awarded. No gag clauses in contracts, and broader protection against retaliation. And here's the press release from June 4th, fairly recent on this wonderful $50 million award. The next largest award was $39 million in 2018. So there's another interesting enforcement action from about a year ago. Facebook to pay $100 million for misleading investors about risks it faced from misuse of user data. That, of course, is related to now infamous scandal with Cambridge Analytica, where Facebook data essentially was given to this academic researcher who now passed on to this other company. He did several things with it, which you are aware, affected American politics quite a bit, in case you didn't know. Facebook was charged by the SEC that it didn't adequately disclose the impact of this breach, essentially. and had to pay just a little bit of a fine of $100 million. Some other notable actions which were noticed: failure to disclose by Mylan of potential liability arising from DOJ investigation. Fiat Chrysler cookie jar reserves, very classic scheme, which were used to, help meet targets. Again, failure to disclose payments to the CEO in retirement by Nissan. Hertz, misstatement of pre-tax income due to accounting errors. Hertz was, as we of course know, recently declared bankruptcy because of COVID-19. So these are, some of the other actions which are very much plain vanilla kind of traditional actions by the commission. All right, so I want to switch away from the enforcement actions, talk a little bit about regulatory priorities. So here's April 2020, Clayton's speech. We continue to allocate our resources in the best interests of investors, capital markets, with investor protection, market integrity front in mind. Keenly focused on ensuring that issuers and other registrants continue to provide material information to investors, including information related to current and expected effects of COVID-19, roughly practicable. And so right now the concern, of course, is adequate disclosure of COVID-19 risks. So we've seen a lot of enforcement activity there, but I bet CorpFin will be monitoring the filings for second quarter in particular of 2020, make sure there's adequate disclosure of risks and uncertainties with respect to COVID-19. Reg BI, that I already mentioned earlier, I was involved in part of that package, not on the BI part, but on the CRS part, has been a signature rulemaking by Chairman Clayton. He really cares personally a lot about that. And so it's become effective. It becomes effective June 30th. In fact, the Commission this week reaffirmed that deadline. It was maybe a concern because of COVID-19 of delaying that. Really very important rulemaking. It's an attempt to say, it's much more targeted, I would say, in my mind, my view on towards broker-dealers, at least the BI part, to raise the suitability standard that they had before on selling securities to best interest standard, which best interest standards I tend to understand as kind of situational fiduciary duty. That's the way I kind of think of it. Not an absolute fiduciary duty that advisors face all the time, but more like in the context of your interaction with a client, you have to have their best interest in mind. So, of course, as part of that, Form CRS needs to be delivered to your clients, which is a disclosure document that's meant to make clients more aware of what they're getting into, of the relationship, and of duties, of conflicts, of any disciplinary actions, and so on. So beyond Reg BI, which has now become effective in Form CRS, Commission has continued to engage in as part of trying to increase access to capital in simplification of disclosure standards. Most recently, some of the simplifications to Regulation SCA, for example, reducing the levels of mandated disclosures and merger and acquisitions activities. That rule was just adopted very recently. So here's some of the summary of the amendments. Also, proposed amendments to the MD&A. They're also moving towards a less prescriptive manner of disclosure of MD&A. They're not huge changes by any means of imagination. But they intend to simplify to some degree, enhance financial disclosure requirements by reducing duplicative disclosure and focusing on material information in order to improve these disclosures. The impact of this simplification is going to be hard to judge because, in my mind at least, they're fairly minor issues. There are some areas where there's disclosures by moving more to principles based, less prescriptive, could omit certain disclosures which some people tend to think of as important. For instance, I saw an example of an argument being made by some analyst where he basically said, I really care about, taking the effects of capitalized interest out of earnings, right? So companies capitalize interest, which is not a huge number, I really want to take that out and make sure it's not, affecting my ratio calculations and so on. So that information was disclosed in Statement of Fixed Charges, which is one of the tables which will no longer be required in this. That's one kind of concrete example that I saw of potential negative impact. How important it is today is I'm not sure that important because I don't know what the relative amounts of capitalized interest and how huge they have been. It only affects a small subset of companies which are obviously involved in construction business, and given the low level of interest rates, I can imagine it's a fairly narrow impact. But nonetheless, this wasn't without the controversy. Again, kind of the Democratic commissioners and investor-oriented community, their knee-jerk reaction typically is, we don't want less disclosure. Now, my view on these things is more circumspect, I should say. We have great amounts of disclosure with demand. If you ever have a pleasure of reading 10K, it's incredibly long. Lots of it tremendously repetitive. And I personally think that I agree with the notion we need to make disclosure more readable and focused, and people otherwise it's just overloading people with information that they don't process. And giving disclosure for the sake of just giving disclosure, all it does is just gives it's for lawyers, really, right? So just give them more opportunity to sue or something later on that they didn't feel was disclosed properly. Also, actually, it could have the opposite effect, is that companies could use disclosure strategically to disclose certain things in a very fine print where nobody would notice, that should be recognized in the financial statements. I already mentioned that they're working on update of the accredited investor definition, which would broaden the definition of accredited investor simply from just the wealth test, which is currently the primary test now. So, for example, they would allow people that pass Series 7 broker-dealer exams to be qualified as accredited investors. This is a proposed rule, also very much opposed by the Democratic commissioners. So here are some of the highlights. The proposed amendments would also add new categories of entities, including catch-all category for any entity owned in excess of 5 million in investments. I would add new categories of natural persons based on professional knowledge, experience, and certifications. Which I mentioned the Series 7 exam and so on. Series 7, 65 AU licenses or other credentials issued by accredited educational institution. So they're essentially saying, okay, we'll look at the educational test, not just at the wealth test. So, as a CPA, I don't know if that means a CPA would qualify to be an accredited investor, but possibly. Or somebody who's a CFP, maybe, I don't know.